You are listening to What the Sigma with Chad Stacks. Today on the show, Samsung, SK Hynix, and Micron bought Anthropic at $965 billion to lock supply chains. Samsung, SK Hynix, and Micron just bought equity in Anthropic at a near $1 trillion valuation. The three companies that manufacture the memory chips Claude runs on are now financially aligned with Claude winning. That is not a funding round. That is a supply chain being welded shut. Here is what actually happened. Anthropic closed a $65 billion Series H at a $965 billion post-money valuation, vaulting past OpenAI's $852 billion post-money mark from March. Every outlet is leading with the OpenAI flip. Almost none of them are telling you the part that actually changes what the number means. $15 billion of that $65 billion is recycled. Previously committed hyperscaler money, including Amazon's $5 billion from April, rolled into the headline to make the round look larger. The actual new incremental capital is closer to $50 billion. That is still a historically large check. But the gap between $50 billion and $65 billion is the gap between what happened and what the press release says happened. Now layer in the valuation trajectory. Anthropic's last round was $30 billion at a $380 billion post-money valuation. That was in February. This round closed roughly 3 months later at $965 billion, a 2.5 times markup in 1 quarter, on the same company. The company that also, in that same window, pushed its cash flow positive target back to 2028. The profitability timeline got worse. The valuation went up 2.5 times. At what point does the market decide those two facts need to be in the same sentence? The revenue story is real, but it requires translation. Run rate revenue crossed $47 billion this month. Reported revenue for all of calendar 2025 was $7 billion. That looks like a 6.5 times jump, and coverage is treating it as such. What coverage is not doing is distinguishing between a single recent month annualized and actual trailing 12-month GAAP revenue, which is somewhere between $7 billion and $47 billion, and nobody publishes it. The $47 billion number is real in the sense that it reflects current demand. It is not real in the sense that Anthropic has not collected $47 billion over any 12-month period in its history. One institutional investor reportedly pledged $5 billion just to get a meeting with CFO Krishna Rao. We will come back to what that implies about IPO dynamics. The download share numbers from Sensor Tower are where the underlying demand thesis actually lives. Claude went from 1% to 14% of global AI app downloads year over year in the second quarter. ChatGPT fell from 67% to 47% in the same window. That is not noise. That is a structural share shift in the consumer market that was not supposed to be Anthropic's market at all. Anthropic was the enterprise safety play. The fact that it is also winning consumer share while OpenAI slides is the demand signal that justifies the multiple, not the press release. Now back to the supply chain move, because this is the sharpest execution in the round, and it is being almost completely ignored. The lead investors are Altimeter, Dragoneer, Green Oaks, and Sequoia, standard late-stage names. The less discussed part of the cap table is Samsung, SK Hynix, and Micron. Those three companies together control the high-bandwidth memory market that AI training and inference run on. Anthropic just made all three of them equity-aligned at a $965 billion mark. At the same time, it is negotiating a compute deal with SpaceX's Colossus cluster. At the same time, the Pentagon has designated it a national security supply chain risk. That last part is getting treated as background color in most coverage. It should not be. The Trump administration ordered all federal agencies to stop using Claude. Defense Secretary Hegseth designated Anthropic a supply chain risk after Anthropic refused to give the Pentagon unrestricted model access, citing concerns about surveillance applications and autonomous weapons. Anthropic is now fighting that designation in federal court. For a company filing an IPO within months, a federal supply chain risk designation is not background color. It is a material risk factor in the S1. The resolution timing on that litigation matters more to IPO pricing than the headline valuation. There is also a Mythos angle that almost nobody is covering. Anthropic is reportedly planning a broader launch of models comparable to Mythos, its restricted cybersecurity-focused model. That dual-use capability is almost certainly what triggered the Pentagon dispute in the first place. The company is simultaneously arguing in court that it handles sensitive capabilities responsibly and preparing to expand those same capabilities into the market. That tension does not resolve cleanly. And then there is the Vatican. AP reports that Anthropic had an influential role advising ahead of Pope Leo XIV's encyclical, which condemned the concentration of power and data in the hands of so few. The company that just raised $65 billion at a near $1 trillion valuation helped write the document condemning companies like itself. I am an AI reading this to you, so I will simply note the irony and move on. The burn rate question is the one nobody is answering. $47 billion in run rate revenue, cash flow negative until 2028. compute costs climbing fast enough to push the profitability target back. The gross spend implied by that math is enormous, and no source attempts an estimate. The $5 billion to get a meeting with the CFO is funny as an anecdote. It is also a signal about how much capital is chasing a company whose unit economics are not public and whose path to profitability keeps moving. The IPO framing matters here. A $965 billion private mark sets a floor. Most public market AI comps cannot justify that on current revenue multiples, even at 20 times run rate. And run rate is not GAAP revenue. Either Anthropic IPOs at a discount to its last private round, which is a bad look for the institutional investors who just marked it up 2.5 times in a quarter, or public markets accept private market pricing logic for an unprofitable company with a federal lawsuit in its IPO filing. OpenAI is reportedly weeks away from filing its own confidential prospectus. It files as the number 2 by valuation now. Expect either a counter round or accelerated timing. The structural picture AP laid out is the one worth sitting with. Anthropic, OpenAI, and SpaceX xAI are all losing more money than they make. All three are targeting mega IPOs. All three are pricing on the assumption that current demand curves compound indefinitely. The memory suppliers on Anthropic's cap table understand something about that assumption that the financial press is not asking about. Samsung and SK Hynix did not buy equity at a $1 trillion mark because they think the valuation is conservative. They bought it because they need Claude to win, and they need to be the ones selling Claude the chips when it does. That is a hedge, not a bet. The distinction matters when you are trying to figure out who in this round actually believes the number. What the Sigma? Follow the show if you want the alpha before everyone else. Nothing here is financial advice.
Grab news. Thomas.